So it was a pretty rough day out there in the market. S&P 500 finished the day down about 2.7%, but it could have been worse. We were trading down as low as 55.60, and I think that was about a 3.25% move. And the Nasdaq finished the day down about 3.8%, just missed a 4% decline. Some important levels were breached today, which may have an impact going forward. We're just going to have to see how this plays out. We managed to close below 56.19 today, and it may seem like a pretty random number, but in reality, it's a pretty important number because when we get below 56.19, there's really not much there in terms of support in the S&P 500. And what was interesting is that we had this big drop on September 18th going into the close, and then we gapped higher the next day, and we basically now have filled this gap at 56.20. Again, like I said, there's just not a lot of support in the S&P until you get to about 5,400 from this area. So it's going to be really important tomorrow to see the S&P 500 snap back and get back above this 56.20 area, at least to start. And then maybe you can mount some sort of effort to reclaim a rally back to around 57.50. If not, we're sort of in an area now where we could see a move back towards this 5,400. After 5,400, you can see there's another gap in here around 5,300, and then really it's back to the August lows of around 51.25. And so this is just a really tricky spot. I mean, from an option standpoint, GEXBot is showing that there's some built-up gamma around here, around 5,500. This was today's activity, and this is really built up tomorrow. So here's an area of support right up in here around 50, resistance right here in 56.30. And even when we look at the option charts.io profile, you can see it's all just negative gamma, 5,500 and then 5,400. So you can see that there's just not a lot, in terms of support on the way down. And so really, this is sort of a critical spot here if you're bullish on the S&P. And, honestly, I wish I could sit here and say that the S&P 500 were cheap, but it's just fundamentally it's not. And that's really what the more concerning part here is that, from a valuation perspective, I know everyone says no one cares about valuation. It's just not, unfortunately, true. Valuation always matters. It's just a matter of when it matters. And, even with the pullback, you figure if the S&P 500 closed today at, 56.15 and we're expected to do, 56.15 and we do, $265 in earnings, the S&P is still trading at 21 times this year's earnings, and that's still a very high multiple. And when we look at where we are now at around 21, I mean, we're still, more than, 7 handles above or 6 handles above where the median is historically. And so you still have a lot of room from a fundamental perspective before the market really starts to make some more sense. And that means that you're not going to see potentially people looking for opportunities in this market, value buyers stepping in, supporting it. So there's a risk here that if we don't see some sort of rebound tomorrow, you could see some further acceleration to the downside. And I mean, I think a lot of what's driving this market is what's really happening in terms of a deleveraging process that we spoke about over the weekend. If you look at the Japanese yen versus the S&P 500 futures, I mean, for the most part, this has been, the story now going back, since the beginning of March. You can even really make a case that this started, well before that. I mean, when you look at a daily chart, there's really only one time that the two really deviated since, let's say, January of 23. That really came in this time zone here. And yeah, I mean, the S&P 500 rebounded much more sharply, but you did get a rebound in the yen, and now the yen is giving back. And the reason why the yen is giving back is because today you saw the spread between U.S. 10s and Japanese 10s break pretty meaningful support level at this 280 area, now trading around 266. So, tonight's Japan session will obviously be very important because, the Japanese 10-year has gone up to 156. And again, this is breaking some really key levels here. And if we continue to see the yen go higher, well, that spread's going to continue to contract. You can see that this is an important area, 156, because after that, after this, you're talking about going up to 160 and then really almost up to 190. So, if the JGB doesn't really start finding some resistance soon, that could also really start moving higher, and you could really see this spread really begin to collapse and move back down to around 230, which would obviously mean that the Japanese yen would strengthen further. And it's really the same thing for the euro, which actually finished today flat. But we're seeing, part of the reason why we're also seeing this is because the euro has been strengthening materially as U.S. and German and U.S. and European rates separate. And that's basically meaning that all the money that's been brought here over the last year or 2 years or 3 years is now beginning to leave and go home. And, what's the interesting thing about today as well, I know lots of people scream about recession risk. And I really still continue to think this is more about deleveraging and money leaving the U.S. and returning home just because rates are moving up and markets are becoming more competitive globally. Interestingly, today, 1 and 2 year inflation swaps actually finished the day higher. And so that's sort of an interesting thing. On Friday, the 2 year swap was trading 278. Today, it's trading 278. And a fractionally higher, but the 1 year swap was trading at 3, and now it's trading just over 301. That's not what you would have expected to see on a day where the S&P 500 dropped by as much as it did, and so that's an interesting development that I think bears watching. And when you even look at inflation swaps over the next several months. This is February, so this is trading for Wednesday, still around 290. By May, we're looking for 250-ish. But then if you go out to October, which is basically trading for August, you can see we're looking for 3% again. On February, which is for November, you're looking for back to 3% again also. So it's interesting that despite all this talk about recession risk, you're not seeing inflation swaps pricing in lower inflation, which would be a suggestion of slower growth. What this is actually either entailing is that the reason why the market's going down is not because of recession, or what the market's telling us is that we're expecting to see stagflation in a much more prominent way than perhaps what we were expecting in the past. And then finally, I guess I'll just touch on this one thing. So in 2022, one of the biggest reasons why I missed the bottom in 2022 was because I was waiting for some form of a signal from the VIX, and we never really got that signal in October of 22. The VIX got up to around 34 to 35, and I was expecting we would see something much higher in a capitulatory type of thing. And ultimately, I as right as I was going into that low, and even though I was able to still get, some shifts and changes up until May of 23, get those changes correct, I was always looking for more because I never really thought we got that capitulatory moment because the VIX never signaled it. So, sort of because I'm such a, because I'm so hard on myself, I really tried to understand how I could miss that opportunity with the VIX. And so I decided to try to look at things in a slightly different way and to come up with another way to think about it. So what I did was I took the VIX and I decided to divide it by VVIX. And what I saw was when I did that was that you did get your capitulatory moment in October of 22. It's just that it was sort of hidden behind its ratio. And, again, looking back on hindsight, now I can see that clearly we did have some sort of capitulatory moment, but it just didn't come in the traditional sense. And so when we look at where we are today, this is where we are right now. So what this kind of implies to me is that we're probably not at a capitulatory type of moment, at least not from an implied volatility standpoint. In fact, the 27.9 that the VIX is trading at right now sort of makes sense, because if you take that and divide it by 16. That gives you a 1.7% move, and we've been moving just about that much, if not more. I mean, today alone, we've been moving more. So the VIX here at 27.28 actually makes a lot of sense. So what I'm going to continue to be watching, so I'll continue to watch this VIX divided by VVIX index to kind of see if that helps me as well. But otherwise, that's all I really have for you. I wanted to try to put something out because I know that tomorrow I may not have time, and I wanted to give an update following the move we saw today in the market. Anyway, please remember to subscribe to this channel, like this video, share it with your friends, and please remember to help me grow my channel in 2025 as we try to go for 50,000 subscribers. Why not? Anyway, have a good one. Bye.